from Toronto. I'm here with Jimmy Levin. He is the co-chief investment officer at Oz Management, with us at the Capitalize for Kids Investors Conference. Jimmy, good to see you.
Good to see you. Great to be here.
This is, as you know, a challenging time for hedge funds, right? The risk-free rate is very low. Passive investing has proved to be perhaps the best idea as of late, because the market, and I'm talking about the stock market, but other markets as well, keep going relentlessly up. How challenging is the opportunity set for hedge funds and value investors in general right now?
So the investment opportunity is always challenging. I think at the moment it feels particularly challenging because of some of what you alluded to. If you look around the world today, equities are basically at all-time highs in almost every market, on an absolute basis and on a valuation basis. High yield spreads are tighter than historical averages, and the all-in yield is at all-time lows, and real estate's at all-time highs, and rates are at all-time lows. So you have all these asset classes at their most extreme, and on top of that, you have volatility at all-time lows. And none of this is new. We read about it every day. It's the headline of every financial paper every day. And so the traditional sources of return, which would be taking systematic risk or valuation risk in all these markets, is less exciting.
You can't think thematically any longer.
It's tougher to do that. There isn't one of these themes like after the financial crisis, there was an unbelievable opportunity to buy the assets that had caused the financial crisis. And after the European debt crisis, there was an unbelievable opportunity to invest in certain European assets. And after the initial energy shock a couple of years ago, there was an unbelievable opportunity to deploy capital there. We don't see a lot of those themes today. So where we try to look, and where we think is most exciting in the market today, is to look for idiosyncratic return streams. And so that usually is found in complexity. And that complexity can be merger arbitrage. It can be liquidations, restructurings, litigations, asset transformations, certain relative value opportunities, something other than simply buying cheap stocks and bonds and loans, because there's not that many cheap stocks, bonds, and loans out there today.
Idiosyncratic and complex usually don't equal exciting.
They don't equal exciting, you're right, but hopefully they equal less risk and more return.
And how challenging is it to find returns in these kinds of strategies? You know, when you look forward, a number of factors have to be considered, right? The time horizon over which these theses are going to play out. Is it taking longer, for example, than it used to? Is it more of a grind?
So it's definitely more of a grind. But I think the goal in those situations is, again, to look for an opportunity where to be right does not require the market to go up, the economy to get better, or any of those broad things to occur. To be right
is that to say, for just a moment,
sure,
that it's dangerous thinking macro right now?
Well, I'll say this: I'm not confident doing it. I don't think we as a firm would be confident doing it. I don't think there's a great history of people predicting macroeconomic outcomes consistently. I think
certainly not recently.
No, I think people do a great job of doing it once. Maybe they do it twice. Maybe they do it 3 times. But I think it's very hard to, at every turn, predict what the world's going to do next. I think that's a hard bar to set for oneself.
And let's go back to the point you were making, what it takes to be right.
Sure. So if you look at a merger arbitrage deal, what it takes to be right is assessing the different factors around whether or not that deal may close. Or what it takes to be right on a liquidation of assets is to understand what the underlying assets are worth, the time it may take to have those assets liquidated, and the cost to liquidate them, and whether or not they are liquidatable. And this is usually in the context of a failed asset or a failed company or some sort of entity that used to be one thing and is now being liquidated. But it doesn't typically require any real brilliance about predicting the future.
Okay, so that raises 2 questions for me. The first is, you have billions of dollars to invest. With the scale at which you need to operate,
sure,
how many of these things are there? How many attractive, exciting, if you will, idiosyncratic and complex opportunities are out there?
So
and how many can you put on at once?
Sure. The key to doing that type of investing is scale. So you're right. If you had to look in one place, in one market, in one country, and you had to deploy a large amount of capital and you had to only do it in these idiosyncratic, one-off type of opportunities, that would be a really hard thing to do. But with the advantage of scale, if you're looking in all the major markets around the world and you're looking within equities and you're looking within credit and within structured credit and within commodities and within derivative volatility products and so on, you only need to find one or two here and there, and it adds up over time.
And how about crowding? Because again, other people are probably thinking like you. They've been burned making macro bets. They share your view that it's very difficult to think thematically right now. And so they're searching for idiosyncratic opportunities and complexity. I've heard it many times. Don't you find other people competing for the same stuff?
Absolutely. And we've always had competition. We will always have competition. That said, I think crowding, it's just one of many factors to consider. So, and we joke about this all the time. If you look back over the last several years and talk about some of the crowded investments that got the most negative media attention and that drew the most investor ire, there were situations like Valiant that were the poster child for crowded. And that obviously was an investment that didn't work out well for investors who had it. You look at something in the credit world like Lehman Brothers. In the history of the 14 years that I've been looking at it, that was probably the most crowded investment I've ever seen, meaning those who had that specialty, generally speaking, owned it a little or a lot. And it turned out to be an unbelievably successful investment. So some things that are crowded are great, and some things that are crowded are terrible. Crowded itself is not dispositive of good or bad. It just means look out if you're wrong, because there's probably a lot of sellers alongside of you.
And here's a question that you may have heard before. It's the baseball analogy. What's more important, to have a good batting average or a good slugging percentage? Would you rather be right more often than you're wrong, or it kind of doesn't matter how often you're wrong, so long as when you're right, you're really right and you're hitting triples and home runs?
It's not your batting average, because batting average doesn't translate to dollars. What translates to dollars is magnitude, not frequency. So if you make more money when you're right than you lose when you're wrong, it doesn't matter how frequently you're correct. So our goal is to try to be correct all the time.
Naturally.
In reality, we've never achieved that goal, not in a given day, week, month, year, or over the 20-some years that we've been in business. But the goal is to, when you are right, make it matter, and when you are wrong, try not to be impaired.
Let's go back for a moment to market conditions. As many people have said, bull markets don't die of old age. Knowing what you know now, how long do you think this one continues?
I can offer very little insight on that point. To the earlier idea, it's really hard to predict these types of things. So I have all kinds of views, and we as a group have all kinds of views. I wouldn't necessarily put a lot of money behind our ability to time when those things are going to happen.
Well, let me phrase it differently then. They all end for similar reasons. What is more likely to trigger a correction or a revaluation at this point?
I think the big items, so the small corrections that we see in markets all the time, where there's a taper tantrum, or there's an upcoming European election, or there's an upcoming bank asset quality review somewhere, those are small items, and they have small impacts, and the impacts are usually temporary. The things that tend to really matter are the difference between growth and recession. When the world's growing, or the big countries are growing, things are generally good. And when they're shrinking, things are generally bad in markets. And so the big question is, what may cause a recession? And in that regard, we don't see a lot of those ingredients that you would normally see. There's not a lot of overheating in different parts of the actual economy. Securities prices seem expensive, but you're not seeing a lot of irrationally exuberant behavior necessarily in a lot of places.
Jimmy, before we finish, a question for you about the state of the hedge fund industry. It hasn't quite been the killing fields, right, that Dan Loeb predicted it would be for hedge funds, but hedge funds, as we established at the outset, have struggled certainly to generate returns, and in some cases struggled with their LPs who want to redeem. What are the biggest challenges for the hedge fund industry as you see them right now?
So first, the word hedge fund means a lot of different things to a lot of people, and I'm not the first one to call that out, but there's 10,000 or so different firms employing all kinds of different strategies, and some of them are terrific, and some of them are probably not as good. Overall, for the industry, I think, like anything, the industry needs to deliver a good product at a good price, and so that good product needs to be whatever the thing is the investor signed up for. And so, if the investor signed up for, I'd like to have great returns with low volatility, then that's what the industry needs to deliver. If the investor signed up for, I'd like to beat the market and I'm less sensitive to the risk profile, then that's what that investor signed up for. So managers, whether they're hedge fund managers or otherwise, they need to, over time, do the thing that their clients would like them to do. So lately, markets have pretty much gone up and to the right. And generally speaking, although you'd be surprised because it's not always the case, the hedge fund industry tends to be hedged to a certain level. So it's very hard for a hedged product to beat an unhedged product in a rapidly rising market. But over time, these things tend to balance out. So if managers can do a good job doing the things that their clients have signed up for, and they can do so at a good price, then there's a great future for the industry.